You're watching Bloomberg Quint. We're getting you a quick update on very significant changes suggested by an internal working group at the Reserve Bank of India on all things banking, actually starting from licensing to the entry of corporates into the banking sector, to the promoter stake, to the roadmap for NBFCs and small finance banks. I will try and give you two or three of the key highlights. These are just the highlights. We are yet to read the entire rationale behind it. But one of the most significant changes suggested by the internal working group is to allow the entry of corporates into banking. Now, remember, this is not the first time such a suggestion has been made. Over the years, the idea has been toyed with multiple times. Most recently, in 2013, it was suggested when a new licensing round was to be permitted that corporates be allowed to come in. But then when the final guidelines for that licensing round came in, they were designed in a manner where pretty much no corporate could actually come in and propose to be part of the banking system. This time around, there seems to be once again a broader suggestion to allow corporates to enter banking, although with changes to the Banking Regulation Act. Now, those changes would entail broadly a change in the supervision structure and also the ability of the Reserve Bank of India to be able to supervise the consolidated results of an entity, hypothetically, which is in banking, but also in other corporate sectors. Now, a brief word on why this issue keeps coming back to the table. Now, it is believed that India needs far more competition in banking, and it needs large-scale, deep-pocketed competition in banking. That people believe would reduce the cost of financial services, will also mean greater access eventually to financial services. And from an economy perspective, it has been believed that that can hypothetically have significant positive impact. But the downside to allowing corporates into banking is also significant, because the worry is that you would see corporate groups start to use their banking operations for their own purposes and for their own businesses, and that could lead to a significant buildup of risk. I must add that in recent financial sector accidents that we have seen, even without corporates being in banking, we have seen a whole lot of that. So I'm not sure which way this will finally play out. It will depend, of course, on changes to the Banking Regulation Act, which the independent working group has very clearly mandated. That's the big suggestion number one. Big suggestion number two is to increase the promoter stake in banks. Now, remember, there has been a multitude of notifications, regulations across different rounds on how much stake promoters can hold in a bank. We saw Kotak Mahindra Bank get into a tussle with the RBI. Across different licensing groups, there have been different rules. But broadly, the RBI had settled on 15% as the maximum stake for promoters. They are now saying that you can go up to 26%, but over a very long period of time, and that is 15 years. So again, the RBI is suggesting easing, but they don't intend to do this in a quick jhatka manner. They are planning to do this over a very long period of time, but at least a suggestion is out there. And I think there is valid reason for that suggestion. There has been very little evidence to suggest that diversified shareholding leads to better governance of banks. We have seen banks like ICICI have trouble, even though they are very diversified in their holding. On the flip side, we have also seen promoter-driven banks like Yes Bank run into trouble. So, it's a debate which can go on both sides. This committee has recommended that you go up to 26% on promoter stake, but over a very long 15-year period. The third important suggestion, and this one actually is very timely, is to allow large NBFCs to convert into banks. They are saying that non-banking financial companies with an asset size of 50,000 crore, including those owned by large corporate houses, may be allowed to convert to private banks subject to completion of 10 years of operations and meeting due diligence criteria in compliance with additional conditions as specified. Now, this is important for two reasons. We have seen some NBFCs go excessively large. Excessively large is perhaps not the right word, but they're large and they're systemically important. Yet they do fall one step below banks in terms of supervision. So there has been a need felt, especially since the collapse of IL&FS, to have tightened supervision on the largest of NBFCs. Now, you can do that even within the NBFC bucket, but recently the RBI deputy governor had argued that perhaps beyond a certain size, NBFC should be encouraged to convert into banks so that they have the same level of supervision and regulation as scheduled commercial banks do. And this internal working group has taken a similar view. Those are the three big ones. I'm going to mention two or three other important ones. One is for new banks. For licensing of new banks, this working group has suggested that you take the minimum initial capital requirement from 500 crore to 1,000 crore. They have also suggested that the non-operative financial holding company structure become the preferred structure for all new licenses. Banks currently under the NOFHC structure should be allowed to exit from any other structure that they may have if group entities are within that fold. There are some relevant suggestions to payment banks and small banks. Payment banks in particular would be allowed to convert into small finance banks if they have a track record of 3 years. This could benefit some, Paytm Payments Bank being one of them. I'm just naming that as an example. There would be others as well. Existing small finance banks and payment banks should be listed within 6 years from the date of reaching a net worth of 500 crores, suggests the committee, or 10 years from the date of commencement of operations. This is just a brief overview of the highlights. It's a long report. We'll certainly get into the rationale and get you a lot more coverage on Bloomberg Quint. But the three big headlines: possible entry suggested for corporates. Once again, a suggestion that promoter stake in banks be eventually raised to 26% over a 15-year period, and that large NBFCs over 50,000 crore be allowed to convert into banks even if they belong to corporate groups. So the three big ones. Do stay tuned to Bloomberg Quint.